Welcome to Tavern Tech Corner, your source for information for ETFs and investing. Hello friends, today I want to talk about ETFs, Exchange Traded Funds. What are they? Exchange Traded Funds are like mutual funds in that you can buy an ETF and it's diversified across many companies. The advantages of ETFs though over mutual funds is unlike a mutual fund, which you can only buy and sell at the close of business, ETFs can be traded in real time when the stock market is open, including in before and after hours trading. So if something happens, like say in September of 2015, Hillary Clinton sends a tweet saying she's going to go after pharmaceutical companies for price gouging, and all of the pharmaceutical and health and other biotech stocks start to plummet, well, you can sell your ETF in the middle of the day at like 10:30 or 11 a.m. instead of waiting until close of business when it's gone down another 10%. This actually happened, and this is one of the reasons that I switched to ETFs only. Here's my current favorite list of ETFs: SOXX, QQQ, VOOG or VOOG, XOY, and LIT. SOX and QQQ are tech stocks. SOX is focused on the chip side, QQQ on the software side. VOOG is an index fund of the top tech companies, SP 500. XOY is consumer discretionary spending, and LIT is lithium and battery technology. Okay, so let's talk about my favorite ETFs. The first one is XLY. This is consumer discretionary spending. The top 10 holdings, as you can see, are Amazon, Tesla, Home Depot, Nike, McDonald's, Lowe's, Starbucks, Target, Booking Holdings Incorporated, and TJX companies. This ETF performs extremely well, as you can see from the graphs. The 3-month average, when I look at 45, 90, and 180 days, the three lines are spread across. There's no inversion, there's no crisscross, there's no T, as some people call it. This ETF is performing well, even with a current tech adjustment that we're experiencing the beginning of the year. The next one is VOOG. VOOG is an index fund. However, it really focuses on the higher performing end of the SP 500. So you can see very familiar companies: Apple, Microsoft, Amazon, Facebook, Alphabet Class A, Class C, Tesla, Nvidia, PayPal, and Adobe. Buying this ETF gets you parts and pieces of all of these companies. The next one is SOX. This is a tech stock focused on silicon chip design, silicon chip manufacturing. So you'll see the usual suspects: Nvidia, Broadcom, Intel, Qualcomm, Texas Instruments, AMD, Marvell, KLA, ASML, and Analog Devices. Of course, there are many more holdings. These are just the top 10. The next ETF is QQQ, also a tech ETF focused on more of the software side of tech. The top 10 holdings you can see here are Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla, Alphabet Class A, Nvidia, PayPal, and Adobe. And the last one I currently like, just because it's lithium and battery technology, is LIT. These are company names I don't really recognize. They're not as recognizable as Amazon's and so on, but these companies are all in the energy market, focused on the new green energies that are coming out. This ETF has done extremely well since June of 2021, and I would expect this ETF to go up even more, especially in California with the push to all-electric cars. Every car will need an electric battery in the future, so there's a lot of growth here, but the performance has been very good in the last 6 months. And the way that I track the investments in the ETFs and make decisions about buying and selling is simply the 45, 90, and 180-day moving averages. I pick these numbers to try to predetermine the changes in the market ahead of the brokers, which typically use the 50 and 200-day moving averages. And I find that if you wait until they trigger their buys and sells, you're already too late. So this is done to kind of get these swings in the market or in these market segments about 10 to 14 days ahead of the brokers. They're about 90% accurate, but the gains and avoiding of losses by being a little bit ahead of the brokers usually wins out that other 10% easily. So why? This graph is spreading evenly. You've got the three lines are kind of spaced equally apart. There is a bit of a dip at the end on the 45-day average as part of the correction that we've been seeing in the tech market at the beginning of the year. Next we have VOOG, and you can see VOOG kind of closely tracks the SP 500 right now, but over time it does do really well. It does better than SP 500, and certainly better than SPY ETF, which is why I switched all my holdings from SPY to VOOG for that particular set of investments. Here's SOXX. This is a nearly perfect graph. The lines are getting further and further apart as you progress through the 90 days, and there's an equal distance between the 45 and the 1 and the 90, and the 90 and the 180. And again, you'll see that the SP 500 has gone up 6.1% in this 3 months, while SOXX is up 14.2%. It's quite good considering the adjustment in the tech market. Next one is QQQ. And again, you can see the lines are fairly evenly apart. You can see back in November, the 45 days started to get a little close to the 90-day moving average. However, it was very shallow. It didn't come in sharp, so that's a hold. And then by December, it started to spread out again. Again, there's the dip at the end, which is part of the overall market tech investment correction. And here's LIT, a little bit more of a correction here, a little bit more of a rise. I'd say LIT is the least of a sure thing of all of these 5 ETFs. However, the growth has been so good at times that I think over the long haul, this one will do well. It's still something to keep a closer eye on than the other 4, though. Well, I hope everyone found that informative, and I know that the start of the year has been a little rough, especially in the tech sector. It's just a normal adjustment, nothing to worry about. None of the fundamentals have changed. People aren't going to stop buying Amazon or stop using Google or stop going to look at Teslas or other cars. I expect that once people get adjusted to the inflation that's coming, the market will pick back up. The type of fiduciary and other changes that happen typically are only temporary slowdowns in the market. As long as the fundamentals are solid, there should be no difference. And again, with ETFs, you're diversified. You focus on the market segments that you care about or the ones that you think are the best earning, which I think is tech. And you keep an eye on these graphs. Keep an eye on my channel for notifications for buy and sell alerts, which I will do on a daily basis when needed. And good luck to us all. Again, obviously, past performance isn't a projection of future, but it kind of is, because the market tends to do between 10 and 12% year over year, at least the SP 500. That's all. Keep an eye out for updates. Let's have a great 2022.